Stock futures are sliding right now as investors try to make sense of the latest Iran war negotiations. The headlines scream that a breakthrough is imminent, yet the market is reacting with fear rather than relief. This disconnect is not a mistake. It is the result of a strategic calculation that you cannot see from the trading floor. By the end of this explanation, you will understand why the regime in Tehran actually prefers a state of controlled chaos over a definitive peace deal, and how that preference is engineered to protect their survival rather than their economy. Here is the thing about isolated financial markets. They do not behave like the global markets you read about in the financial press. When a country like Iran is cut off from the international banking system, its stock exchange becomes a closed loop. Internal dynamics take over. In 2020 and 2023, researchers analyzed the Tehran Stock Exchange and found that volatility was not driven by external news or geopolitical stability. It was driven by endogenous herding dynamics. This means investors were not reacting to facts, they were reacting to each other. When the regime creates uncertainty, the local market absorbs it as a form of liquidity. A definitive peace deal would break this cycle. It would force the market to reprice assets based on real economic fundamentals rather than the speculative premium of instability. Consider the incentive structure for a regime facing sanctions. The goal is not economic growth in the traditional sense. The goal is regime survival. To maintain power, the leadership needs to control the narrative and the flow of resources. If they sign a comprehensive peace treaty, they must open their economy. They must integrate with global markets. This exposes the underlying fragility of their financial system to external scrutiny. It removes the ability to manipulate domestic sentiment through the threat of external conflict. By keeping negotiations open-ended and maintaining a posture of controlled chaos, they sustain a state of perpetual crisis. This crisis justifies the diversion of resources to security apparatuses and allows the state to print money or manipulate exchange rates without the immediate shock of a market correction that a peace deal would trigger. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. The research into these isolated markets reveals a specific pattern. When the market is isolated, volatility acts as a strategic hedge. It allows the regime to sustain domestic liquidity. They can move money around within the closed system to pay off key constituencies or fund proxy operations. A sudden peace would cause a systemic shock. It would likely lead to a rapid devaluation of local currency as the speculative bubble bursts. This would expose the true depth of the economic crisis to the population. The leadership prefers the volatility of ongoing conflict because it keeps the population focused on external threats rather than internal failures. This is where the concept of escalation ladders becomes critical. Real-time conflict monitoring data shows that military actions are not random. They are calibrated. Strikes are timed to trigger temporary asset spikes without causing a full-scale regime collapse. These spikes are not accidents. They are signals. They tell the domestic population that the state is still active and powerful. They also signal to regional rivals that the regime remains a viable threat. The leadership calculates that a temporary spike in oil prices or energy premiums during a crisis is more valuable than the long-term stability of a treaty. The asymmetry of market reaction is stark. Narratives about a peace deal cause immediate oil price drops and futures corrections. Narratives about ongoing conflict sustain higher energy premiums. These premiums are the lifeblood that funds state operations and keeps the security apparatus loyal. Think of the financial system as a pressure valve. If you seal it completely, the pressure builds until it explodes. If you leave it open, the pressure releases slowly. The regime in Tehran has chosen to keep the valve slightly open. They engineer the controlled chaos to manage this pressure. This requires a distributed information architecture where military actions are synchronized with financial market openings. They want to maximize the volatility impact when the markets are most active. This trade-off prioritizes short-term regime survival over long-term economic stability. It is a rational calculation for a leadership that believes their time is short. They are betting that they can survive the instability longer than their enemies can survive the pressure. The structure of the Tehran Stock Exchange decouples local asset valuation from global peace signals. This means that when a peace deal is announced globally, the local market does not necessarily celebrate. Instead, it may react with suspicion. Investors know that the regime has a vested interest in keeping the conflict alive. They know that a peace deal would require reforms that threaten the power structure. Therefore, the market prices in a discount for political risk that is far higher than the geopolitical risk. The regime understands this. They use regional military posturing as a tool to manipulate domestic sentiment without needing actual de-escalation. They can threaten escalation to keep the population mobilized and the economy in a state of siege, which justifies their authoritarian grip. This brings us to the core insight. The market slide you are seeing is not a sign of a deal failing. It is a sign that the deal is not happening. Investors are reacting to the realization that the regime has no incentive to sign a definitive peace. The controlled chaos is not a bug in the system. It is a feature. It is the primary mechanism of survival. The regime is willing to let stock futures slide and the economy stagnate because the alternative is a total loss of control. They are trading economic stability for political continuity. This is a strategy that has worked for decades because the cost of a definitive peace is higher than the cost of perpetual conflict. The specific numbers from the academic analysis of these isolated markets show that herding behavior accounts for a significant portion of the volatility. In periods of high geopolitical tension, the correlation between local trading volume and external news drops to near zero. This proves that the market is running on its own internal logic. The regime has engineered a system where the only way to win is to keep the game going. A peace deal ends the game. It forces a reset that the current leadership cannot survive. So when you see stock futures sliding on news of negotiations, do not assume it is a sign of optimism returning. It is a sign that the market has priced in the reality that the status quo will continue. The regime is not seeking peace. They are seeking a managed state of instability that allows them to extract resources and maintain power. This is the strategic logic that drives the behavior you are observing. It is not about economics. It is about survival. The market is reacting to the fact that the leadership has chosen the path of least resistance for their own political future, even if it means economic pain for the country. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.